Production overheads represent indirect manufacturing costs that cannot be directly traced to individual cost units, but are essential for supporting the production process. Unlike direct materials and direct labor, overhead costs benefit multiple products or departments simultaneously and therefore require systematic allocation and absorption procedures before product costs can be determined accurately. Effective overhead accounting is fundamental to management accounting because it ensures accurate product costing, inventory valuation, budgeting, pricing decisions, and performance evaluation. Consequently, management accountants employ various allocation and absorption techniques to distribute overhead costs fairly and consistently across production activities. A fundamental distinction exists between direct expenses and indirect expenses overheads. Direct expenses are costs that can be specifically identified with a particular cost unit or job and are therefore charged directly to production. Examples include royalties paid per unit produced, specialist equipment hired for a specific contract, or subcontractor costs directly attributable to a customer order. Together with direct materials and direct labor, direct expenses form part of the prime cost of production. By contrast, indirect expenses, commonly referred to as production overheads, cannot be directly assigned to individual products because they support multiple production activities simultaneously. Examples include factory rent, machinery depreciation, factory insurance, power, maintenance, indirect materials, indirect labor, and production supervision costs. These overheads must therefore be allocated or apportioned systematically before being absorbed into product costs using predetermined overhead absorption rates. The determination of production overhead absorption rates, OARs, involves several sequential procedures. First, overhead costs are collected and classified according to their nature. Secondly, overheads are assigned to cost centers through allocation and apportionment. Thirdly, service department costs are reapportioned to production departments where necessary. Finally, total production department overheads are divided by an appropriate activity measure, such as labor hours, machine hours, or direct labor cost, to calculate an absorption rate. The resulting rate enables overhead costs to be charged consistently to products based on actual production activity. The initial distribution of overheads involves allocation and apportionment. Allocation assigns entire overhead costs directly to the cost center that incurs them without estimation. For example, the salary of a factory supervisor responsible solely for Department A is allocated entirely to that department. Allocation is appropriate only where costs can be identified specifically with a single cost center. In contrast, apportionment distributes shared overhead costs across several cost centers using equitable allocation bases. Factory rent may be apportioned according to floor area occupied, electricity according to machine power consumption, insurance according to asset values, and canteen costs according to employee numbers. Appropriate apportionment ensures that each department bears a fair share of common overhead costs, while improving costing accuracy. Following primary distribution, service cost center overheads must be reapportioned to production departments, because only production departments manufacture products. Service departments such as maintenance, stores, personnel, and information technology provide support services to production departments, but do not produce output themselves. Reapportionment distributes service department costs according to measures such as maintenance hours provided, employee numbers served, or requisitions processed. Where service departments provide services to one another, the reciprocal method produces the most accurate cost allocation. This method recognizes mutual services exchanged between service departments before allocating final costs to production departments. Reciprocal allocation may be performed using simultaneous equations or repeated distribution methods, ensuring that all interdepartmental services are recognized before product costing calculations are completed. Once total production department overheads have been determined, management accountants calculate overhead absorption rates using an appropriate activity base. The choice of absorption basis depends upon production characteristics. Direct labor hours are appropriate where labor-intensive operations dominate production, while machine hours provide better cost allocation where automated manufacturing processes prevail. Other bases include direct labor cost, units produced, or material cost, where these better reflect overhead consumption. Selecting an appropriate absorption base improves product costing accuracy and reduces cost distortion arising from inappropriate overhead allocation. Management accounting systems also require appropriate journal and ledger entries for manufacturing overheads. Actual overhead costs incurred are recorded by debiting the production overhead control account and crediting cash, payables, or accumulated depreciation accounts. As production proceeds, absorbed overheads are transferred by crediting the production overhead account and debiting the work in progress account using the predetermined absorption rate. The production overhead account therefore accumulates actual costs, while recording absorbed costs transferred into production. Because overhead absorption rates are predetermined using budgeted figures, actual overhead expenditure and actual production activity rarely equal estimated values. Consequently, underabsorption or overabsorption of overheads frequently arises. Underabsorption occurs when absorbed overheads are less than actual overhead costs incurred, indicating insufficient overhead recovery through production. Conversely, overabsorption occurs when absorbed overheads exceed actual expenditure, suggesting excessive overhead allocation to products. Under or overabsorption may arise because of inaccurate budget estimates, unexpected production volumes, seasonal fluctuations, changes in efficiency, or abnormal overhead expenditure. Significant under- or overabsorbed balances are typically transferred to the income statement or adjusted through inventory valuation, depending on organizational policy and accounting standards. Continuous monitoring of absorption differences enables management to improve budgeting accuracy and refine future overhead absorption rates. Overall, effective overhead accounting provides an essential foundation for accurate product costing, inventory valuation, cost control, pricing decisions, and managerial performance evaluation. By systematically allocating, apportioning, and absorbing indirect manufacturing costs, management accounting ensures that product costs reflect total resource consumption and support sound operational and strategic decision-making.